Reaching your retirement goal might actually require you to save less. That sounds counterintuitive, but I'm not talking about reducing your savings rate overall. What I mean is directing less money into the wrong types of accounts. Consider this scenario. You've accumulated 7 figures in your employer retirement plan, but you're only 52 years old and ready to walk away from your career. The problem? That massive balance is essentially inaccessible. You'll face early withdrawal penalties, enormous tax consequences, or you'll need to navigate complex distribution strategies just to use your own money. This is how many people become asset-rich, yet liquidity poor. What I want to walk you through today is why channeling less into tax-deferred retirement accounts and more into what I call a flexibility account could be the difference between retiring on your terms versus remaining handcuffed to a timeline you didn't choose. For decades, the financial advice industry has hammered home a single directive: contribute the maximum to your employer plan, fill up your deductible retirement accounts, push taxes into the future, and watch those balances grow. That guidance isn't incorrect, but it's seriously incomplete. Retirement isn't solely about how much you accumulate. It's equally about when and how easily you can access what you've built. Accessibility is where countless retirement strategies fall apart. Let me paint a picture that illustrates this perfectly. Imagine you're 52. You've diligently saved, and now you're sitting on a substantial portfolio, let's say around the $5 million mark. But every penny lives inside tax-deferred accounts. You've done everything the conventional wisdom prescribed. Then suddenly your situation changes. Maybe you experience complete career burnout. Perhaps your position gets eliminated and the job market looks unappealing. You're mentally finished with the corporate grind. When you check your account balance, the numbers suggest you have the resources to stop working. $5 million should provide freedom, right? But then reality sets in. To actually use that money before 59 and a half, you're looking at limited options, and none of them are particularly attractive. You could wait years until you reach the penalty-free withdrawal age. You might establish a substantially equal periodic payment arrangement, which involves complicated calculations and inflexible annual withdrawals. You could begin a conversion strategy to move money into after-tax accounts, but that process takes years to provide access. Or you could simply accept the 10% penalty on early withdrawals in addition to ordinary income taxes. None of these options represent freedom. They represent restriction. You did everything correctly from a savings perspective. The money exists, but the account structure means you lack practical access. The vehicle holding your wealth is controlling your life decisions rather than the actual value of your assets providing independence. Let me clarify an important concept that many people misunderstand. Contributing to a traditional retirement account doesn't eliminate your tax obligation. It doesn't even reduce your lifetime tax burden. It postpones your taxes. This postponement works magnificently when your income during working years pushes you into high brackets, perhaps the 35 or 37% range, so you're avoiding 35 cents of tax on every dollar you contribute. Then in your later years you withdraw that money when your income drops into the 12 or 22% brackets, paying substantially less per dollar. That's the arbitrage opportunity that makes these accounts valuable. But consider a different scenario that's actually more common than many realize. You save aggressively throughout your career, building substantial tax-deferred balances. You retire with every intention of maintaining a comfortable lifestyle, similar to what you enjoyed while working. Except now, all your spending money must come from withdrawals that trigger ordinary income taxes. You're not going to land in that low 12% bracket because pulling enough money to support your lifestyle keeps you in much higher brackets. In this situation, those early tax deferrals may not have provided much benefit at all. You saved successfully, but in doing so you concentrated all your future tax liability into one account type. That concentration now limits your flexibility. This brings us to the solution, the flexibility account. Legally speaking, this is simply a standard investment account with no special tax treatment. But functionally, think of this as your freedom account because it removes the restrictions that bind your tax-deferred savings. The beauty of this account type is remarkable. There are no age-based restrictions, no penalties for accessing your money early, no contribution caps limiting how much you can save, no mandatory distribution requirements forcing you to withdraw on the government schedule. What does this mean in practical terms? It means you control everything. You decide when to sell investments and realize gains. You choose what tax rates apply based on when you harvest those gains. You can access this money at 65 or 55 or even 35 with identical rules applying. The flexibility account creates options, and options are what enable retirement, not just your total net worth. Let's compare two scenarios. In the first case, you have $5 million entirely in tax-deferred accounts. In the second case, your neighbor has only $4 million, but their assets are diversified across account types. Some sits in tax-deferred space, a significant portion lives in a regular investment account, and another chunk exists in after-tax retirement accounts. Who's actually better positioned? You have a higher net worth on paper, but they likely have greater practical freedom. They can access their money without restrictions. They control the timing and tax implications of their withdrawals. They're not constrained by arbitrary rules about when they can use their own resources. They have complete control over their income timing and withdrawal sequencing, which translates to far more control over their tax bill during retirement. Now, you might be thinking this only matters for people wanting to retire before the standard age, but this flexibility remains valuable even after you pass 59 and a half. Here's a pattern I consistently observe. Someone retires with most assets in tax-deferred accounts. They've dreamed about retirement activities, purchasing a recreational vehicle, taking an extended international trip, remodeling their home, bringing children and grandchildren on special vacations. But there's a harsh reality they often overlook. Whatever you think these goals will cost, if all your money is tax-deferred, add 50 to 70% to that estimate. You want to remodel and take a family trip for $100,000? You actually need to withdraw $160,000 or more, depending on your bracket, because the entire distribution is taxable income. You might intellectually understand this concept, but the psychological impact is profound. You just spent decades accumulating and growing this money. You finally reach the point where you can retire. Now, to actually enjoy what you saved for, you must withdraw significantly more than you need and write a massive check to the tax authorities. The difference between taking $100,000 from an already taxed account versus taking $160,000 from a tax-deferred account isn't just financial. The psychological weight is enormous. Try convincing yourself to pull out $160,000, knowing $60,000 immediately goes to taxes, just so you have the $100,000 left for your actual goal. That's a difficult mental hurdle. When every spending decision must be filtered through the lens of paying an additional 30 or 40% in taxes, you simply won't make those decisions as freely. You'll talk yourself out of experiences you genuinely wanted. All those retirement dreams you envisioned, many go unrealized, not because you lack the resources, but because the psychological barrier of generating large taxable distributions prevents you from actually spending what you've saved. Compare that experience to having diversified account types. When you need funds, you can draw from your investment account, where gains are taxed at preferential long-term capital gains rates, often much lower than ordinary income rates. You might even utilize the 0% capital gains bracket available at lower income levels. You can consider borrowing against your portfolio. You can blend withdrawals from your tax-deferred account, your after-tax retirement account, and your investment account to optimize your tax situation. The level of control you maintain with diversified account types, not just diversified investments, is substantially greater. Financially, the flexibility account provides lower-cost access to your money through reduced taxes, but it delivers something even more valuable. It feels different psychologically. It genuinely feels like freedom. It feels like something you can actually use without the mental obstacle of generating huge tax bills with every decision. At this point, let me be clear about what I'm not saying. I'm not suggesting you should avoid tax-deferred accounts entirely. These remain powerful wealth-building tools that absolutely deserve a place in your strategy. What I am saying is don't automatically funnel every dollar into these accounts without understanding the broader context. Don't blindly maximize contributions without recognizing both the benefits and the limitations these accounts create. Often the right approach includes contributing enough to capture any employer matching funds because that's immediate guaranteed return. Then evaluate your current marginal tax rate. If you're in a high bracket today and expect to be in a lower bracket during retirement, tax-deferred contributions make excellent sense up to a point. But simultaneously build flexibility by funding accounts with different tax treatments. This isn't an either-or decision. It's a both-and strategy, but you need intentional amounts allocated to each account type based on your specific goals and timeline. So when I say you might need to save less to retire, I mean less to the wrong account types, not less overall. Make sure every dollar you save is directed to an account that serves a clear purpose. That purpose should empower you and provide freedom rather than imposing restrictions. Retirement isn't about reaching a particular age or hitting a specific portfolio value. It's about having choices. The more optionality you build into your financial plan, the more freedom you'll experience when you actually stop working. If you need help constructing a plan that balances all these considerations, that's precisely the type of work comprehensive financial advisors handle. The objective isn't merely accumulating wealth, it's building freedom on your timeline, not on the schedule the tax code imposes. When you design your savings strategy intentionally across multiple account types, you're not just preparing for retirement. You're preparing for the flexibility to retire when you choose, to spend on what matters to you, and to make decisions without artificial barriers constraining your options. That's the difference between a retirement portfolio and a freedom portfolio.